In this video, we're going to be talking about how important fundamental analysis is for picking stocks. Now, even though I'm not of the opinion that fundamental analysis is that powerful when it comes to forecasting stocks, I still acknowledge that there are some qualities about long-term investments, such as low volatility and increasing dividends, and many more characteristics that I feel that are important for long-term investing. And a lot of these characteristics are dependent on how healthy a company is doing. If there's lots of free cash flow, if earnings are good, then it makes it a lot easier for the company to do share buybacks, such as McDonald's has done for a very long time now, or increasing dividend payment, such as Apple and Microsoft, who, even though they haven't been increasing their dividend yields for that long, they have been increasing their dividends very rapidly. And I acknowledge that free cash flow is a big part of that. So there is still some element of fundamental analysis that I incorporate within my long-term investing. Definitely not my short-term investing or swing trading, but I want to go through some of those features and basically my stress tests that I put my stocks through. Now, first thing I want to talk about is screening. So how do I screen for stocks that I consider to be very good investments? Number one, I want to have stocks that have increased their dividend yield payments for at least 25 years. Most of the time, these are going to be dividend aristocrats, and sometimes they're dividend kings. The reason why this is my first stress test, and of course, there are going to be some exceptions. I do have some stocks in my portfolio that haven't met this requirement. But for the most part, this is my core requirement. And the reason for that is because it is a stress test, which means that stocks are generally healthy if they can meet this requirement. It shows that they have been growing for a very long time, and over the past 25 years, we have gone through exactly two recessions. So, if you can increase your dividend yield payment during a recession, it shows stability. So, stability and strength are two features that I consider very important in long term investing. It's very similar to a company filtering out job applicants. And this is unfortunately the way that the real world works is if you come from a very good school, a very prestigious college or university, for example, you will most likely have preference when it comes to hiring for lots of companies. And that's because these companies understand that in order to have graduated and done well at really elite schools, it means that you're persistent and it means that generally you are going to be intelligent. And these are some qualities that companies are definitely looking forward to when making their job application decisions. And I apply the same philosophy to my own investing world. I want to have stocks that can meet a really good stress test, first of all. The other feature that I look for is diversification. When we're talking about these companies that have increased their dividend yield payments for such a long time, generally it means that there are a lot of businesses and brands within a single business. Johnson & Johnson, for example, spans a lot of industries. Even though they're considered a healthcare stock, they are extremely diversified. Even within Johnson & Johnson, there are a lot of chapters and divisions. Even Coca-Cola that I have on the screen has lots of brands. It's not just Coke as a brand, but they also own other smaller brands, and most of these brands have come from acquisitions. Acquisitions that have been made possible because Coca-Cola is such a cash cow. Now let's go back to the core question, which is how important is fundamental analysis? I was saying earlier that I don't place that much emphasis on fundamental analysis, and honestly, that's definitely the case. And for that reason, I usually just pick between the basket of dividend aristocrats because that proves to me that these companies are fundamentally sound, and there's not that much advantage that the individual investor has when it comes to fundamental analysis, in my honest opinion. I mean, we can know almost everything about a company, but it doesn't mean that the company will have good returns over the long run. Now, that doesn't mean completely throw it out of the way. If it's your preferred method of analysis, then by all means you can go ahead and continue doing so. Especially if it works for you, then it works for you. Don't let me tell you otherwise. It's just that, in my personal opinion, it's not very good when it comes to predictive power. It's more about understanding how healthy these companies are. And I know that sounds a little bit contradicting, but in the real world, stock prices don't always reflect basically how companies performing. There's sometimes not that much correlations between a stock price and the underlying business or news and other factors like that. I thought it'd be a good idea to go over my dividend growth pie just to show some examples of stocks that I'm purchasing and why I'm purchasing those stocks. This portfolio over the past 5 years has increased by about 51%. So annualized on average, that's about a 10% increase every single year in terms of capital appreciation alone. And the other thing is the dividend yield is about 3.176%. So 3% in terms of dividend yield and 10% in terms of capital appreciation gives it close to around a 13% performance annualized, but it's definitely going to be a little bit higher than that, especially because I am going to be including dividend reinvestments as I go on throughout the years, and I'm obviously going to be purchasing shares as they get cheaper throughout the years as well. This portfolio has about 34 holdings, which I think is a solid amount. I think anything more than 50 and you'll start to get a little bit diluted and you'll start to represent the market maybe a little bit more than you want to. So 34 holdings is basically my sweet spot, and I think anything up to 40 holdings is fine as well. There's currently no expense ratio, which is something that I really like. And so yeah, let's go ahead and walk through some of these holdings. I basically have a few main allocations. There's some stocks that I would have a 4% target on, and there are a few stocks that are basically just a 2% target on, which I'm not super crazy about. However, the main reason for the allocation doesn't necessarily mean that I'm picking favorites. It can also mean that at the moment, I think that the 4%ers are showing the most amount of value right now, and I would like to place a little bit more emphasis and a little bit more cash flow into some of these companies. You'll notice that out of a lot of the 4%ers, it's basically industrial stocks and consumer packaged goods stocks. So with the industrial stocks, we have 3M, we have Caterpillar, and we have Honeywell. However, with the consumer packaged goods sector, we have Clorox, Coca-Cola, Colgate, and Pepsi. The third sector that I would consider to be pretty common among the 4%ers is healthcare, which is Johnson & Johnson and Pfizer. And healthcare, in my opinion, is showing a little bit of value right now. So that's why I'm incorporating a lot of cash into some of these sectors. So let's talk about some of these industrial stocks, for example. This is 3M over a long-term perspective. As you guys can see, it has definitely taken a hit over the long run. The all-time high sits at around $260, and currently we're at $163. Now, in my opinion, because 3M has increased their dividend yield for at least 50 consecutive years, I would consider this to be a value. If we take a look at some of the long-term moving averages on a monthly time frame, we can see that it's still above both major moving averages. And so this, in my opinion, means that 3M is still in a long-term uptrend. We're just showing a little bit of volatility in the near term, but no reason to panic. 3M also pays around a 3.5% dividend yield at the moment. And they have four business segments, which are safety and industrial, transportation and electronics, healthcare, and consumer. So like I said, they meet both of the requirements that I consider to be very important for my long-term investments. Let's go ahead and take a look at another industrial stock. This one is Caterpillar, which is also showing significant volatility. But like I said, also what I find important is that Caterpillar is above both of its major moving averages. And it's not that common that we see these wild swings like we've seen right now and over the past few months. Caterpillar is a large company coming in at $67 billion market cap. Their dividend yield is also close to about 3.5%, and they own approximately 16% of global market share in 2017. The other important thing is that they are also divided into four business segments, which are construction industries, resource industries, energy and transportation, and Caterpillar Financial Services. Once again, meets all the requirements that I consider to be important for a long-term investment. And so the main takeaway of this video is to try to do as little fundamental analysis yourself as you can. I mean, if it is your cup of tea and your preferred strategy, then you can go hunting through 10Qs and earnings reports and earnings filings and try to find diamonds in the rough, especially with stocks that aren't that discovered yet. But in my opinion, it's way more useful and practical to basically look for stocks that have already been screened and then try to find value within those stocks. Because one of the main takeaways is that if you're looking through stocks that basically haven't been discovered yet, maybe they're fundamentally sound, but the other thing is that they have to have been picked up by other large financial institutions as well. And those large financial institutions should have the same thesis that you do. There's not that much power that you as an individual investor have. And I understand we glorify Warren Buffett in this day and age, and for very good reason. He's probably one of the most successful investors of all time. And right now, he's one of the wealthiest people of all time, and he is absolutely huge on fundamental analysis. But let's not forget some of the main reasons of why he's so wealthy. He had his own hedge fund in his 20s. I'm guessing if you're watching this video, you probably did not own your own hedge fund in your 20s. He also made really lucrative deals with CEOs to basically sell their share prices at a higher price than they currently were, and make deals with the CEOs, because he would basically own really large percentages of really small companies, basically really trashy stocks. And so that's basically how he came to own Berkshire Hathaway, is because he purchased such a large part of Berkshire Hathaway, which was basically a failing textile company, and he made a deal with the CEO to sell his own stake at a higher price than it currently was, making Warren Buffett a lot of profit. But what happened was the CEO basically said, we will not purchase the shares at this price, we'll purchase it at a slightly lower price. And it ticked off Warren Buffett so much that he ended up just buying all of Berkshire Hathaway. And the other thing about Warren Buffett is that he buys stocks with preferred dividend yields. He doesn't get your average 2% dividend yields or 3% dividend yields. Whenever he purchases something, he gets close to 8% or 10% dividend yields. And that's with, including all the major bank stocks like Bank of America, Wells Fargo, Morgan Stanley. And throughout the 2008 crisis, he also made very good deals with large banks that were basically failing and really close to going under. But Warren Buffett basically bought preferred shares, where he not only financially engineered large amounts of dividend yields, there's also a lot of other incentives for Warren Buffett to get into these basically companies. And so that's how he makes instant profit. So long story short, even though he's famed for all this fundamental analysis, he's made a lot of his money by literally picking up the phone and making deals with CEOs, which is not something that you or I have access to. So in my opinion, the less fundamental analysis and guessing, then the better for your financial health. And one of the main advantages that a lot of these other companies have is that they're picked up by a lot of financial institutions, because increasing your dividend yield every single year means that you really care about your shareholders. And that means a lot to financial institutions and individual investors, because they can count on some kind of income and they can count on some kind of stability. The other thing is that these companies tend to be very, very massive and very well diversified, as I mentioned earlier in this video. So because of that, they also tend to be in a lot of retirement plans. And when people invest in index funds, these companies tend to be very large parts of those index funds and ETFs. And so you can pretty much guarantee that a lot of passive investments and passive cash flow will actually enter these companies as a result of that. And the last thing I want to say is that they generally tend to outperform the S&P 500, both in terms of capital appreciation and less volatility. As you guys can see from this portfolio, this is basically a 13% annualized portfolio. And basically the main takeaway that I also want to make is that even in times of significant market volatility, as we've seen between 2015 and 2016, and even between 2018 and 2019. What this portfolio has done is basically given less volatility than the S&P 500, but also we make higher lows and higher highs. So while the S&P 500 actually is at a lower point now than it was in 2018, we're basically really close to all-time highs here with this dividend growth pie. And even throughout this period as well, we made a significantly higher low, as you guys can see. So strength is definitely not a problem with dividend aristocrats as well. So that's where I'm going to wrap up this video. I hope you guys enjoyed it. Hope you guys learned something, and let me know if you have any questions. Basically, this question was inspired by a commenter, which is Cecilia Baker, who asked about how she can invest the remaining $2,500 in her M1 Finance account. And so hopefully this video can shed some light on what I would do if I was basically in her situation. Thank you guys for watching, and I'll see you guys in the next video.